India took almost 60 years to reach $1 trillion in economy, but the next $1 trillion took only 9 years. The third trillion happened in 7 years, and the fourth trillion happened in less than 5 years. Good morning, everyone. Thank you so much for taking out time on a busy Monday morning to join us and listen to our thoughts. Thank you, AFM, for inviting me, and it's my privilege and honor to share the stage with other dignitaries. So thank you so much for coming today. A little bit about APME. For those of you who don't know, APME stands for Association of Portfolio Managers of India. It was set up on 31st of December 2021, after a long-standing wish of industry to have a unified voice within regulatory landscape as well as stakeholders for portfolio managers. In last 3 years, APME has done a lot of work in the span of investor awareness for partners like yourself and distributors. On May 2024, SEBI mandated APME to create a similar system, similar to ARN, the AMFI ARN, for portfolio manager distributor. The 21A exam obviously was launched a few years ago, and all of you are familiar. Few numbers which I'm sure you recall. The number of ARN holder is roughly between 1.5 to 2 lakh in India. The number of people who have given 21A exam, which is a portfolio manager distributor exam, is roughly about 20,000. So a 10% of the subset of people who are, let's say, doing wealth management through mutual fund, essentially also work with portfolio managers. There are 2 separate exams for alternative investment fund manager distributor. That is not yet mandated, but I'm assuming with the way regulatory landscape is going, you will very soon see more professionalization for wealth managers. Of that 20,000 people who have roughly cleared the exam, I think as of the mandate for APRN, which is the APME registration number, will be live from 1st of January. For now, I believe roughly 2,000 people have already registered as or created their APRN number within APME. And we'll see the growth. I don't see a major chunk of people, given the vast landscape of India with B30, C30 and a lot of other nuances. But PMS as an asset class obviously is evolving, and I'm sure yesterday's keynotes and yesterday's sessions obviously gave you a perspective in terms of what an investment manager can bring to the table, especially when he's sort of running a boutique investment management house. What I have put together is I've put together a few slides from different surveys, both national as well as international. And we are trying to kind of give you a food for thought in terms of where this industry is going and what is it that will eventually work out. Some of these trends you may be already seeing. Some of these trends have happened in the West and probably will come up in the East, in India as well as we grow. So the obvious, which you already know, is the India's GDP story. So India took almost 60 years to reach $1 trillion in economy, but the next $1 trillion took only 9 years. The third trillion happened in 7 years, and the fourth trillion happened in less than 5 years. And as we are speaking, we are a $4 trillion economy. Now from here to the next 4 trillion. So from 4 trillion to 8 trillion, we are looking at about 7 to 8 years time horizon. If you are optimist like us, you will say 6 years. If you are a pessimist, you will say 8 years. But the time has come for India to deliver on this. So the wealth which we have created over last 75 years, you will witness the same amount of wealth in next 7-8 years, right? Now, what does it mean for you? What does it mean for client? You all know the amount of financialization of savings we have, right? The recent RBI data says that we are roughly investing about 3% of the savings, the domestic savings, into stocks or mutual funds or otherwise, right? Now, let's assume that the financialization of saving doesn't increase, it stays at 3-4% or whatever that number you have. But the economy doubles from 4 trillion to 8 trillion. Automatically, all of your assets will double, right? Now, if there is a slight change with respect to the percentage uptick, which is due to financial literacy and a lot of your efforts and other things, the growth would be exponential, right? And that is what you are witnessing here. You guys are one of those lucky lots who will witness the exponential growth in the wealth management side of the industry. And I'm sure you are already seeing, last 5, 6 years or 7 years, you're already seeing the amount of wealth which you have. Maybe some of you have been in business for about 20 years. You would have seen that what has not happened in last 15 years has happened in last 5 years. So we underestimate the change, but when it happens very quick, right? Gone are the days when you have to explain them what is a product, what is stock market, what is mutual fund, what is PMS. Now there are reverse inquiries which clients are obviously giving you. Now this $8 trillion economy will happen primarily because of 4 Ds, as we call it, right? Democracy. We are one of the vibrant democracies in India, and we continue to kind of do that. Apologies. Domestic consumption. Our economy is not export oriented, unlike China. We are mostly domestic oriented, and that helps, us to be proof from any external shocks. Demography, young population, more education, and that is helping. And the last is digital dividend. Now, had you tried to kind of do a e-natch mandate 20 years ago, on ask a client to do a Aadhaar-based KYC maybe 10 years ago when Aadhaar was launched, or do a digital transaction from someone maybe 15 years ago, he would have said no, right? So if you were a wealth tech firm and started your business 15 years ago, or if you're Amazon started in 2000, you would have failed miserably. Why? Because the ecosystem was not there. For some of you who will remember, the first Amazon of India was India Times or Rediff.com. But when they launched, there was no ecosystem with respect to online payment, to access to mobile phones, access to internet, and hence obviously they couldn't do that well. Fast forward 15 years, the circumstances, the infrastructure is there, and obviously, anyone who is launching right now does well. And same is the story with wealth management. People are so aware with respect to what products and why do they need wealth management per se, which is kind of, taking this demand up. Now, this is a survey, done by one of the industry reports recently. And what they found out, and this is specifically for maybe wealth managers, what they find out was that accessibility to the manager or responsive to answer question was the #1 priority for family offices or investors, right? If you see, returns is also there, but returns is ranked 4, right? So returns are good, and obviously they make the bulk of what you need, but they are not necessarily the first, requirement for a client. So client definitely is asking for transparency, client definitely is asking for robustness of the process, and obviously accessibility to the manager. Now, obviously manager is not omnipresent. He cannot be everywhere. So he has to obviously talk via you, which means more and more of you are required to talk to, the managers, to the clients from that perspective. So keep this in mind. Clients want more interaction, right? The key takeaway from this slide is client want more interaction. The next one is how often do, and I've used the word advisors. I understand the difference in India with respect to advisors and wealth managers, but think of it as a wealth manager. This includes advisors as well as, the MFDs as we call it. But how often do wealth managers put clients' interest first, right? And this may be a perception. This may not be a factual data. This is the perception of investors, right? So the perception of investors is that about 35% of people think that you are always working in their interest, right? That doesn't mean 2/3 don't like you. They like you. It's just that you haven't told them that you are working for them, right? And as long as you tell them, I'm sure they will turn their gears around and go from there. Now the usually 49% is a task which you have to move from that category to this category. And bulk of your growth in wealth management will happen when you move that 49% to. Now the 12%, 3% and 1%, leave it. But the 49%, if you were to able to move half of it on this side, I think half of your job is done, right? Now I'm sure you are working in the interest of client, but it's also important to tell them that you are working in their interest. Now, wealthy clients, are they satisfied with personalized offering, right? And there is a difference with respect to, this is from a Capgemini remote of 2019. Essentially, depending on the age, right? Young guys, they obviously need more, 1/3 of them obviously need more personalized. Between maybe over 60, which are kind of maybe already retired or they already have some wealth, they want hyper kind of, customized solution. and all clients are roughly 38% satisfied with the personalized service. So more and more services requirement would be more personalized. You can't kind of have one product which fits all the baskets. You can't have one product which fits all the client. Well, yes, some of the products are great, but they may not fit with the risk profile or the requirement of all the clients which you're looking at. And hence, you ought to look at new asset classes, new products, new managers, new kind of options which are available, right? The same option available maybe, in a traditional MF format or maybe a good old fixed deposit, you will have much more. Like, for example, a lot of people, instead of doing fixed deposit, will prefer now a liquid MF. I mean, we are not talking about taxation, but generally speaking. And the same thing will happen over in terms of other asset classes. Within equity, you will have options with respect to what you want to do depending on the asset class. Now, obviously everything is good. Then why do client leave? Or why do client think that they have got something wrong, right? And this is a survey which was done a couple of years ago. And obviously it still kind of meets what you're looking at. Now, 4 top reasons why investors have bought wrong financial products, right? First one, obviously, they bought it without thinking too much, which obviously which might happen if they're doing direct, if they don't have any intermediation through a RIA or maybe a MFD from that perspective. Bought it because I trusted the seller too much. Now, that is where obviously all your behavioral aspects, all your trust aspects come into play, right? And then obviously the remaining 2 are general. I mean, obviously, last part is still a worry because people end up combining tax planning and investment planning, which all of you know is not a right mix, right? One needs to have separate tax planning and separate investment planning. Now, you have all the tax saver funds, but eventually, if you can differentiate, that pool can help, right? So, these 4 reasons, I think if you start solving them one by one with your clients, growth will automatically happen. If you explain to your client, if you have transparent reporting, if you give them product features, risk, etc., eventually things might come your way. On AI, now, of course, India is a large market and we are yet to reach and penetrate a lot of, population with respect to financial intermediation. But I'm sure all of you have now started using ChatGPT or, AI or anything from that perspective. You will be surprised to see that people are more comfortable in asking AI about their financial problems than about other work. You would have thought it otherwise, saying that people might ask different questions in terms of GK or otherwise, but you will see 45% of the people are sort of taking some sort of a guidance, or they are increasingly becoming comfortable about consulting AI, right? Now, AI obviously can give you all sorts of answers irrespective of knowing you in general, right? And when you know the client, obviously in particular, you can talk about what is specific with them. Now, this could be an opportunity, right? And that is where I think you need to identify what is noise and what is knowledge, right? AI can give you a lot of answers, but are they customized? Are they specific to his requirement? Maybe not, right? But this is something which keep in mind in terms of you have to be technologically enabled on what you are doing or otherwise. Now, this survey is done by CFA Institute. They do this almost every other year. And obviously, one thing to note is that the trust levels with respect to investors on advisors or maybe financial wealth managers is very, very low. We are almost next to mechanics or politicians. I mean, there are other professions which are trusted higher than us. I'm not saying you guys are not trusted. I'm sure you guys are trusted. But that is something which is kind of, impacting. For some reason, despite all the regulation, despite all the professionalism, despite everything else which you've been doing, the trust levels in financial industry are still very low. Is there a reason to it? It could be lack of education. It could be, some key cases which have been highlighted. It could be, in general, the frauds which are happening in the industry, or it may be lack of education. For all you know, it might never be, not a single one of your client. But the whole aspect is that this is still the case. Now, the trust levels have increased. So the good thing is they've increased, right? Be happy about it. They were maybe, half of it what, you would have seen otherwise. But they are still abysmally low. Like compared to a doctor, which is 77%, and you, which is 23%, we make 100% of the trust, right? So be familiar with what you can do to increase the trust factor. And I think it's all a relationship game. You guys are not into transactional business. And as long as that relationship is developed, I'm sure trust will evolve, and if trust is evolved, business will automatically come. Those are the only maybe thoughts I have. I mean, obviously I have a few more in terms of where traditional players and wealth tech firms are joining hands, and so there are obviously tools which people are adding to their practice to kind of make it better. The next gen wealth requirements are very, very different than the old gen, right? The personalized strategy is something which people are looking at. Now you have options to kind of, add more asset classes available in the market domain. Robo-advisory is something which is picking up. I'm not too sure in terms of how much it can work in India, given the nature of products or otherwise, or maybe whether it can analyze everything. For a plain vanilla product like an ETF, maybe a robo-advisory might work, but for other customized strategy, I find it very hard to believe that it might work from that perspective, but nonetheless, that is a trend which is still coming. I'm out of space and out of time, but three things. Regulations are going to be more and more stringent, so be ready for becoming more professionalized, whether it is exams, whether it is platforms, whether it is product choices. There is a new framework by RBI called account aggregator. I don't know how many of you have heard through it, but that is something which might have a lot of impact on how you are servicing, because that gives you ability to get a lot of information. And the last is have focus on future with respect to innovation, financial stability, data security. Confidentiality is something which is required. Thank you so much and for your patience and your time.
Thank you so much, sir.